you can save a substantial amount of money in a workplace retirement plan like a 401k. And with those high limits, you're able to really get some tax benefits today or possibly set yourself up nicely for later. So let's spend the next couple of minutes talking about exactly how that maximum works, because there are a couple of different ways to get money into a plan, a couple of different sources. Then we'll also chat about the annual limits currently and the taxation and a couple of other items. This might be helpful if you're fortunate enough to be able to contribute up to the max, or if you just want to know exactly how these things work, because it can be helpful to have that information. By the way, this applies to many workplace retirement plans, not just 401k plans, but a lot of 403b, TSP, some 457 plans, etc. You certainly want to triple check with your employer and your plan administrator or the various retirement plan vendors to find out exactly what the rules are for your plan, because each plan can be different depending on the employer, but the maximum limits can apply to a variety of different plans. This does not apply to those IRA-based plans, though. So a simple IRA or a SEP IRA is going to work quite a bit differently, so look up different rules for those. And what I'd say is that not everybody reaches the maximum contribution limit every year, but clients are often surprised at exactly how much they can put into these plans on a yearly basis. And especially if you're self-employed, you might really have a lot of latitude in terms of setting up a plan that lets you make some really powerful contributions, like mega backdoor Roth contributions, for example. As a refresher, there are two basic ways for money to go into a 401k plan. So those are employee contributions and employer contributions. The employee contribution is an amount that you decide to put in out of your pay. So you sign up and you say, take X percent, or take a couple $100 a month, couple $1,000 a month, whatever the case may be. That's your employee salary deferral contribution. The other source of money is employer money. So that might be if your employer chooses, and it's not necessarily required, your employer would choose to match your contributions perhaps up to a certain limit. They might make profit sharing contributions. They might be required to make other types of contributions to keep the plan running nicely, but whatever the case may be, that money comes from the employer. As you can see here, the employer money is always going to be pre-tax money, and that's because the IRS basically says if somebody got a deduction for making these contributions, then the money will eventually have to be taxed when it comes out of a retirement plan, and your employer often gets a deduction because it's an employee benefit expense. So that's even the case with nonprofits. It just has to go in as pre-tax type money and would generally be taxed when it comes back out. But the employee contribution, and by the way, the employee contribution is always 100% immediately vested. That is money that you earned and decided to put into the plan, so that's your money. You can't necessarily pull it out right away when you want to. There are rules on that. You may need to terminate employment or get a loan or a hardship withdrawal or something like that. I have other videos on those topics, but the employer money might have a vesting schedule. You might need to work at your employer for a certain number of years to be 100% vested in that money, and the employee money is always 100% immediately vested. That money can go in as either pre-tax or Roth. You might even have the option to make voluntary after-tax contributions in some plans. That's not necessarily a widespread feature that everybody has available, but those are the three basic types of employee contributions. You've got your pre-tax traditional contribution that will reduce your taxable income for the year that you make the contribution, and then you would typically pay taxes on that money when you take it out of a pre-tax account. The other one is a Roth contribution, and sometimes that's listed as after tax, but it's different from the voluntary after tax. The Roth contribution does not give you a reduction in your income today, but if you meet all of the IRS requirements, then when you pull that money out later in retirement, it can be tax-free income. That can be really helpful, not only because you don't have to pay taxes on it, but it might have less of an impact on your Social Security taxation, for example, or your Medicare premiums, or qualifying for other types of things on your tax return. So that's one reason to consider Roth. And then if you do have that voluntary after-tax contribution, what typically happens, the goal is to put that money in there and then convert it more or less immediately over to Roth so that it can grow tax-free until you need to spend that money. That's usually not available in plans because it makes the plans fail certain types of tests. Those voluntary after-tax contributions can mess that up because it is typically the people who are better off who are making those contributions, and if the folks who are less well off aren't contributing nearly as much, that can cause some problems. But if you do have a solo 401k or an individual 401k because you're self-employed, then you may be able to set up a plan that does that, where you can make those voluntary after-tax contributions and do a mega backdoor Roth strategy. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, you're going to find some links to some of the things we're talking about here, as well as some resources that are just general retirement planning information. I think you'll find all of that really helpful, so be sure to check that out. This is also a good time for a friendly reminder. It's just a short video. We can't cover everything here, so please triple check all of this with your CPA, your employer, your plan administrator before you take any action. It really is important. We've also got the catch-up contribution, and that is for those who are age 50 or older in the year in which they contribute. So if you reach 50 in November, that's fine. You can still do a catch-up contribution for that year. So that goes on top of all of the other maximums. So we've talked about the different types of contributions. Let's get into some actual dollar amounts here, and we'll talk about 2023 because 2022 is more or less over. But the total limit of all the different sources that could go into your 401k for you would be $66,000 before the catch-up contribution. So if you are 50 or over, you can add the $7,500 catch-up contribution on top of that $66,000. That's quite a bit of money, and many people don't make it there. However, if you are a high-income earner or your employer is particularly generous, you can certainly hit that limit and wish that you could contribute more. That's a nice problem to have. When most people are thinking about the maximum 401k contribution, they're typically thinking about the salary deferral contribution, or how much they can put in out of their own pay. And that is, again, $22,500 for year 2023. The reason I keep mentioning the year is that these limits typically increase periodically to keep up with inflation, or to at least try to keep up a little bit with inflation. So the limits are going to change every year. You definitely want to keep track of that, especially if you're trying to make those maximum contributions, because you may need to notify your payroll department or HR or whoever does all of that, that they need to increase your contributions if the limit increases. So let's walk through a quick example. Let's say you make $85,000 per year and you're going to max out your 401k. So for 2023, you're doing that $22,500 salary deferral. Your employer matches your contributions dollar for dollar up to 4% of pay. Let's say that's what's called a safe harbor contribution. It helps them pass those tests. And you're over 50, so you qualify for a catch-up contribution. So your total additions to the plan for the year would consist of the salary deferral of $22,500 plus employer matching of $3,400 plus your catch-up contribution of $7,500. If the annual limit was $66,000, or it's actually $73,500 once we add in the catch-up because you're over age 50, that leaves $40,100 until you actually hit the maximum of $66,000 or $73,500. So you have $40,100 of room. Now, there might not be any opportunity for you to make that contribution. And if that's the case, then that extra room would go unused. And that's, again, often the case for many people. They don't hit the plan limit each year. But if your employer decided to make additional profit-sharing contributions, that's the maximum that you could receive. Or if your plan allowed these voluntary after-tax contributions, then that's how much you could put in under that bucket of money and potentially convert that over to Roth money for a mega backdoor Roth strategy. So that's the basics of the maximum contribution in your 401k. Now let's get into some frequently asked questions that trip people up sometimes. And the first question is, does the employer contribution affect how much you as an employee can put in? And in most cases, the answer is no. So let's say you've got that salary deferral limit of $22,500 per year, and your employer puts in $5,000 of matching contributions, let's say. That would not reduce the amount that you're allowed to put in. You could still do the full $22,500. Now, in some cases, and this is really for really high income earners, we're talking hundreds of thousands of dollars here. In some cases, those employer contributions can take up so much space that you don't really need to make the full employee contribution. So why would you put money in if they're going to put it in for you? So in those cases, it doesn't necessarily mean you couldn't contribute, but what happens is you don't need to. So in those cases, the amount that you contribute out of your own pay is generally reduced, but again, that's a pretty rare case. How about IRA contributions? So if you contribute, let's say $7,000 to an IRA, is that going to reduce what you can put into your workplace 401k plan? Again, the answer is generally no here. That's not going to affect it at all. They are separate limits. There's an IRA contribution and there's a 401k salary deferral contribution limit, and contributing to the IRA is not going to affect your 401k. Next, do you have separate limits for Roth and pre-tax salary deferral contributions? So if you've got your $22,500 limit, could you do $22,500 to Roth and $22,500 to pre-tax? Unfortunately, the answer is no. So that dollar limit is, let's call it 100% of your limit. And then you can split up your contributions however you want if your plan allows Roth contributions. So you might do 100% of it over to Roth. You might do 100% pre-tax, 50-50, 70-30, 30-70, whatever it is that seems to make sense for you is what you can do, but you don't get to double the limit. That brings to mind another question people often ask is that if I make Roth contributions, will I get matched? And will those count for the matching calculation? And the answer is yes. So don't worry about using up or wasting some of that matching contribution if you contribute to Roth, because they will match your Roth contributions if there is a match. How about when you work multiple jobs, or if you're self-employed and you have an individual 401k, a solo 401k plan? How does that work with all of these 401k maximums? Well, the first thing to know is that the salary deferral limit is generally limited to just one per taxpayer per year. So that $22,500 for the year 2023, again, you could do that once, whether you put it in one plan or the other, you split it between the two. That limit you typically only get once. There is an exception. That is if you have a 457 plan. So that might be available to, let's say, city employees. And in that case, it's possible to double up. But for most of the people out there, there is only one limit per taxpayer allowed. The employer contribution is a little bit different. So in that case, you can potentially hit the maximum twice. And this depends on what types of money, the sources of contributions we're talking about, but it is possible to hit the overall plan limit of $66,000 twice. That can get really complicated. We're not going to get into a deep example here, but what I would say is check with your CPA, talk with your employer and your plan administrators. Let everybody know what's going on and what you're trying to accomplish, and then they can tell you if it's possible to do that. So if you have really high earnings, let's say, again, we're talking hundreds of thousands of dollars, and you have a solo 401k and maybe a retirement plan elsewhere, it could be possible just through employer contributions to max both of those out, or maybe you do some employee contributions in one of them or the other. But the thing to remember is, number one, it's complicated. You have to check on this. Number two is if the employers are considered related in the IRS's opinion, then you wouldn't necessarily get to double that maximum. So they have to be completely unrelated employers. And by the way, other types of retirement plans might be treated separately as well. So if you have a defined benefit or a pension plan, any money that goes into that is not going to affect your 401k plan maximum. typically there may be some interplay there. So again, you have to talk to the plan administrator, make sure you understand all the moving pieces. But in many cases, those types of contributions don't count against you. Now let's get into some limitations on how much you can contribute, because you might not be allowed to reach the 401k maximum. So even if you wanted to, you have the earnings and everything like that, you might not be allowed to contribute the maximum to your 401k because of certain situations. The main issue here is probably going to be non-discrimination tests. These plans have to benefit everybody in the workforce at your employer. So it can't just benefit the owners or the highly compensated people or the key employees, for example. It really has to benefit everybody. So that is an attempt to make it fair for everybody and to offer access to everybody. But in some cases, if people don't contribute enough, if let's say the lower earning employees don't contribute enough to the plan, then a plan could fail these non-discrimination tests. It's pretty easy to fix if you add a safe harbor to the plan and the employer does a certain type of match or a certain type of contribution. This can easily be remedied, but not all employers do that. So if your plan is failing these non-discrimination tests, what might happen is you might get a refund at some point because they say you contributed too much. Another potential limitation might be if the plan document, for whatever reason, has some sort of limitation in there. It's usually a relic of a really old plan design, and there's not necessarily a good reason for that anymore. So it can, again, typically be updated, but just be aware that might happen. So what if your employer doesn't offer a 401k plan, but you really like these high annual limits and you wish that you could contribute up to the maximum? What can you do about that? The ability to contribute to a workplace plan typically relies on your employer, and it's a choice if they choose to offer that to employees. It takes a little bit of administrative expense and time and energy, a little bit of risk as well, so not every employer is going to do that. You can certainly ask your employer to start a plan and let them know that you're interested, maybe talk with some other employees, and perhaps volunteer to help be on a committee with vendor selection and investment selection and plan design and all that, so that you can take a little bit off the plate of your employer. That might or might not fly, but it's always worth a try. All they can do is say no. But if you don't end up getting a plan, then you may need to just save money elsewhere. So a couple of options for that include a taxable brokerage account. That's just a very simple way to go about it. You have to put money somewhere, and if you don't have a lot of choices with nice tax features, then that's a perfectly good option. You put the money in, it's very flexible. You can use very similar investments and invest for long-term growth or be conservative or whatever you want to do in there. The other option is to use, of course, IRAs or individual retirement accounts if you're eligible to use those, and use all of the different features of those, because depending on your income and a lot of other things, that can get a bit complicated, but that's definitely worth looking into. And you might be able to put money into an HSA or a health savings account. Those are really powerful accounts because they're triple tax exempt. So the contribution goes in a pre-tax manner, it reduces your income, and then the growth inside of there is tax deferred. And then when you take the money out eventually, assuming you meet all of the IRS requirements, you use it on qualified healthcare expenses, etc., then in that case, the money would come out tax-free. So it's similar to the tax-free treatment of a Roth, but really just for healthcare expenses, and you get a deduction when you put the money in if you qualify to. So look into that, check on the rules, and see if that's an option. I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you, and take care.